All right, testing, 1, 2, 3. Testing, 1, 2, 3. Testing, 1, 2, 3. Testing, 1, 2, 3. G'day, mate. How are ya? How's your mum? Welcome to Forex.Today, where we teach you how to be the prophet of profit. As currency traders stationed around the world, we're interested in Forex and everything about Forex. Today, we're likely to cover Australian dollar, New Zealand dollar, Canadian dollar, American dollar. You got a dollar, we want a dollar. We'll also do some yen. We'll also do some, how about some ZAR, lira maybe, peso, gold, oil, Bitcoin. Yeah, whatever you want. It's your way because you're the boss. I'm just a humble currency trader. We're going to realign our satellites, check out the markets, put together some plans. Not just survive, but thrive together. So let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, and never risk money you can lose. So g'day, mate. How are ya? How's your mum? My name is Wayne McDonald. I'm a currency trader just like you. This community, Forex.Today on YouTube, is comprised of nearly 14,000 foreign exchange traders stationed around the world. We're coming here together as a community to align our satellites, synchronize our watches, put together our plans so we can take over to the world. I feel like, what's his name? Dr. Evil. So anyways, cool. Ask questions, get involved, take notes, all that kind of stuff. Treat your fellow currency traders here in the chat with dignity and respect. And also, don't forget to pay it back. If you're benefiting from these daily webinars, you must thank our sponsor. Visit tradersway.com today. Open a demo account today. Honestly, less than 30 seconds, you're in. But then you can download MT4. Give them an opportunity to earn your loyalty and respect. Play some trades. You'll find out the execution speed is fast. I tested that with a third party. They're much faster than the vast majority, especially the big ones, right? What else? The spreads are narrow, very, very competitive. Swaps are huge, much bigger than most. And of course, if you ever need it, world-class customer service. Roll a red carpet out for you. Butler white glove treatment. Pour you a bath. Put some bubbles in it. Sir, would you like a chocolate chip cookie fresh out of the oven? Yes, I would. Thank you very much. That's what it's like. Tradersway.com. You're like, man, a warm bubble bath. That was enough. But the fresh baked cookie? You're the greatest, Traders Way. Thank you. All right, coolio. Right on, David. Hey, did you use the new installer at MetaTraders? Now it's super ridiculously dummy easy now. Very cool. Okay. Cool. Neat. So ADP came out at 8:15. Of course, half the world thinks it's the end of the world, and the other half of the world thinks this is ridiculous. This COVID thing. And so anyway, so let's take a look at the news. And what happened was some people were like, 9 million people have lost their job. And it came out 2 something, right? What, 2.7, 2 point whatever. So cool, bad, but we already knew it was bad, but it wasn't like the end of the world bad. So lots of millions of people have lost their job, but probably, as a central banker would say, that trend would be transitory, which means as things are opening, they get their jobs back. Okay. CAD to crypto. What does M1, M2, 1? Let me tell you. Okay, so you got the templates. Cool. You don't know how to trade with them. Visit fxbootcamp.com. Take advantage of the 80% discount. The link is in the description below. The 80% discount's going away very soon. I mean, dude, you're asking me a question. I mean, I can answer it. It doesn't mean anything to you. You need the education. There's at least 35, probably closer to 50 hours of education there. You need to jump on that now. So you got the tools, but now you need to know how to use them. Okay. But you know what it means, CAD? The midpoint. The M stands for midpoint. Okay. So that's all I'm saying. But that's meaningless, right? Oh, it's the middle point between S1 and S2. But once again, that doesn't mean anything to you, right? You have to have the everything behind it. But anyways, there's the answer. Let me get that up there for you. Is that better? Is that all right? 4 p.m. Pranav. 4 p.m. New York time, of course. What's up, RC? RC Cola's in the house. All right, so anyways, this is just, I think, where we left off. Pound Swissy climbing, climbing, climbing. Remember, I said this week, things are going to be unusually bullish until we get to somewhere between the Wednesday and Wednesday. There's a high propensity for that to change. So because of the high propensity of that to change, bulls have to get their bull on sooner than later. So what's happened since I've made that wild and crazy prediction? Up, 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 down, down, buy, 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 up, 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 up. And that's continuing. But between the Wednesdays, that is not probably, there is a high, because of event risk on the calendar. That's what event risk is. Okay? Because of event risk, there's a more than reasonable chance that there's going to be a change in trend, or there can be a change in trend. Not that it will, we don't know the future, but there's enough event risk coming up on the calendar that everything good and holy about this bullish trend can come crashing down. Okay, and you got to know that. Okay. Okay, cool. So that's continuing, and you can see on an hourly basis. Isn't that cool, guys? So, right, these are demarking an uptrend. You understand that? Okay. And not opinion, just statistics. Simple statistics. Okay. The next thing is the 21 is above the 55, which by definition means this market is bullish. Okay. Next one is the 21 EMA defines the bullish market and is a dynamic level of support. Okay. This is all out of my book from 15 years ago. Nothing new. Okay. And then the pivots, the daily pivots now, because remember I told you back on Sunday, and then again on Monday, then again on Tuesday, I told you, even though you have a monthly strategy, because of what I think is going to happen based on behavioral finance, my outlook is to say, well, trade your weekly and your monthly strategy using daily pivot points. And that meant this is a buy zone. This is a buy zone. So you didn't get that one because it was extremely bullish, but that's what I talked about down here, that there is likely to be this so extreme bullishness that if you're too slow, you're likely to miss things. Okay. And then yesterday, right? That was the buy zone for today, and this is tomorrow's buy zone. Okay. Now, what happened yesterday during our webinar? We were here. Okay. So check that out. Our indicators said at that time, if you get a chance to buy it around this price, you probably should. And it worked because you have the roll reversal, you have the 21 EMA, you have the pivot points, and you're done. Now, interesting is we just hit our target for the day. This is why I say you got to plan things ahead. You can't come into New York and like, hey, buddy, what's up? Are we bulls? Oh, I guess it's been up for the last 24 hours. I guess I should buy? No, dude, you're going to get crushed. You're going to get slapped, kicked in the teeth, kicked in the shin, laughed at and mocked at. But maybe down here is a better idea. Mohammed says, will risk-off settlements start today? I don't know. So, for example, almost 3 million people lost their jobs, according to ADP, for the month. Is that good or is that bad? Now, I want you to answer this, Mohammed. Is that good or is that bad? 2.7 million people lost their job. Okay. So, Rookie is all over it. It's fantastic news, guys. It's unbelievably awesome news. So sorry, Rookie. Sorry. Now, why is it good news? Yeah, sure will, Raymond. You know, the interesting thing is, like, it's funny how people have their breakthroughs, right? Like, none of that is different from what we've been saying for 20 years, but it's another way of learning the process, which is really super cool. But like this idea of like, hey, if you look at long-term technicals or fundamentals, you develop a bias, and then you only trade that bias. And then you look at monthlies, weeklies, dailies, right? And you're aligning market conditions with that bias, right? Like it's, but whatever clicks, right? Cool. Yeah. So people thought it'd be a lot worse, which means they don't think they invest or they trade or they place orders and all that kind of stuff. So people thought, now I don't know where they get their thoughts from, and it's irrelevant to me actually, but I don't know where they get that thought process. When someone says, oh, it's going to be 9 million, I'll say, really? How'd you come up with that analysis? What did you study? Like, what trends are you seeing? Well, people are dying of COVID. Yo, I know. But how do you know that? Are you tracking some sort of, warehousing data? And you're finding, shipments are way down, and you've talked to 5 or 10 different warehouse employees at various warehouses around the United States and find out they're laying off workers, and they just happen to use ADP because there's mid-size warehouses, and so shipping is way down and orders are way down and work's way down. So, I mean, how do you come up with that? And they're like, it's just bad, everyone's dying. And unfortunately, most people make these wild, crazy predictions, and there's no basis to it. Well, Raymond, I think what's helpful is this idea of, really drilling in. And of course, I have to switch this up. Okay. So, right, like this idea that everything has price action. For every up, there's going to be a down. For every up, there's going to be a down. For every up, there's going to be a down. Okay? Now you can take this on all time frames, because it will happen on all time frames, right? So because here's the interesting thing. On a higher time frame, this is an hour. So on a daily, this is a daily candle, right? And in the swing trading group, we talk about we trade inside the candles, right? We trade inside the wicks, right? So now if you drew this properly with a wick, there's your open, there's your high, there's your close, and there's a wick here, okay? And then there's going to be, right? And so what we're looking for now is sort of a bearish wick usually, and then a new bullish candle, right? And that's all we're doing every day as, let's say, day traders, right? A day trader every day is looking for the green candle, the pullback, the green candle. You're already in it, so you don't care about the green candle. You already bought. Then the pullback, right? And all this is doing is creating little wicks above and below real bodies. But this is, so you buy down in here because it's a roll reversal and you're buying off that. And then it produces another one, right? And you're like, okay, I knew that. And now what? You're still a bull. So now you need a pullback, right? And then, but you're a bull. So you're buying the next candle. And you're still a bull. So right? And then you're going to have a new candle. And you just keep doing that over and over and over, right? So price action tells you that. Moving averages also tell you that, because this is why I do like the 2155, in the old book. That gives you the market conditions. So there's your bias. It's all set, right? And this tells you to take profit. This tells you to get back in. This tells you to take profit. This tells you to get back in. And it's kind of the same thing. It's just using different algorithms to kind of measure the flow. Or if you don't like that, you can use pivot points. These step ups tell you should remain to be bullish. And of course, what you're trying to get is you'd like this down, right? You'd like this to come down. You'd like this to come down, but it doesn't always because it's so extremely bullish. So you might say, well, I kind of like the step ups. That's helpful to remain bullish. You might like the 2155. That's helpful to remain bullish. But where is the real opportunities? The pullback to the 21, right? For example. And that's what my whole book was 15 years ago, is aligning, those market conditions. Or to get the same measurement, how can you measure this to this? Well, that's what a stochastic oscillator does. Right? So now you can say, well, I don't really like the noise in here that the 5/8 cross creates. Okay, well then get rid of the 5/8 cross. Why don't you use a stochastics? Because a stochastics is simply measuring, there's a higher high, higher low, higher high, higher low, higher high, higher low, no higher high, higher low, right? And then higher high, higher high, higher high, but no higher low. Then no higher high, lower low, no higher high, low, no higher high. So now the oscillator's coming back, trying here, again, coming back, and then all of a sudden, boom, right? And so the oscillator is helping you with your timing, and that's what this is, right? There's all kinds of wonderful goodness here. So if you're only using price action and you're not using pivot points and you're not using the moving averages, okay, you're using this. Okay? There's support, so a bull would buy there. There's no doubt. And you also have resistance here, right? Well, that's going to be a new buy later in the future. And so now check this out. You get the breakout. How do you trade a breakout? You catch a pullback, long gone. Then what do? You do it again. So now you got this resistance, and now it becomes support in the future. So now you wait for that to come down, and you buy it. Gone. And then what do? You look at the old resistance. This is a new buy zone. So what do? You buy the dip. And now what? And, and it's just over and over and over and over and over and over. But the thing is, you could do this. So this is an hourly candle, and you could treat it off the moving averages, or you could use the price action, or you can use the 5 EMA, and you can try to, you can't miss these, right? Those are the conservative ones. Or you can look at this instead, get the same data on a 4 hour. But now you're inside the 4 hour candle, so Now you're a little closer and a little less refined, but you still know this is resistance and this is going to be support. You still know this is resistance, so that's going to be support. So on and so forth, right? And you just keep climbing up the ladder. But you don't have to have this tool, but the 2155 cross says this is bullish and aggressive. Right? And aggressively bullish. Aggressive. I probably misspelled that. But the point is, what I've been teaching you for 20 years is that in this situation, don't be a bear. Don't think about being a bear. Don't dream about being a bear. Don't fathom about being a bear. Okay? Bears will have their turn, but what did I say? You develop a bias, right? And then you check market conditions. So what is that called? Develop a fundamental bias and then check market conditions. What is that called? Oh, Raymond, that's just pivot points. That's easy. Okay? That's easy. If you're using position trades, you probably need to pay attention to seasonality because some parts of the year you'll be in it for a month and other parts you'll be in 3 months. That's not that difficult. When you're using swing trades for weekly, you get out at the targets. Not a problem. And then daily, you have to understand, well, are you using the daily to get in your weekly? And are you using weekly to get in your monthly? But it's still the same thing. Like, yeah, you almost don't even need the daily targets for daily pivots, right? Okay? But anyways, guys, this is called strategy. That's it. Strategy. Okay? So when I say you need to trade your strategy, I don't really care about what technical indicators or what your favorite chart pattern is. That's irrelevant. Who cares? Every single one of us in this room right now can trade differently and still make money. So I don't care what tools you use. I don't care anything about that. Because that's just technical analysis. That's the easiest part. Okay? Okay? If we're all bulls on pound Swissy, we can all trade it differently and still make money. So I don't care if you use MACD, stochastics, CCI, whatever. Some magical indicator you created on your own, whether you use no tools at all, just a blank chart, whether you use Renko or not, Ikimoku Yuku Chuchu, that's all good, dude. You'll all make money. Why? Because you got your bias correct and you're trading in a market that's favorable to your bias, which is another way of saying you're a bull and you're buying dips in an uptrend. That's all you have to do. I don't care how you do it. You don't have to do anything I do except buy dips in an uptrend. If you can get that right with your methodology, you will succeed. You understand? Right? I'm downselling you what I do. It's not me, baby. Okay? Well, Raymond, so you got out early. Remember, I told you on Sunday that my experience, nothing on the charts, but my experience tells me this is going to rally up hot and fast and hit monthly targets. Okay, early. Remember, guys, even on Monday, I shared it with Forex.Today. I said OOPCT. Okay? And if you don't know what OOPCT means, then you should take the training course so you know. Because even if I tell you, if you don't know the logic behind it, or even if I drill it down, most people don't do it anyway. So you need to understand how the market works. Okay? Look at that Bitcoin move yesterday. Yeah, you're welcome. All right. Okay. So here's the interesting thing, Raymond. You're kicking yourself for getting out too early, I suppose. There is no such thing, by the way. Also, you did the exact right thing probably, I'd say, 9 months out of 12. And you're kicking yourself because you were profitable, but you could have been a little more profitable. Don't do that. Okay? You did the right thing 9 out of 12 times. 9 out of 12 months. It's very unusual for what happened. I called it because it's not unusual for these conditions, but it's unusual on average. Yeah, well, see, then Raymond, that's you. Here's the thing. Here's the thing, Raymond, because you've been around. You're not a kid. You've been around, and you were not nervous. Don't say that. That doesn't sound good. Okay, you're risk averse. You sensed risk in the market and you managed that. Your nervousness tells you something, but never say you were nervous. Okay? So you did profit taking at a logical, intelligent, pre-planned area in front of massive event risk. So you manage that risk appropriately by stuffing money into your account or into your client's account one day, right? And you're just like, I'm not interested in that undue risk. What day did you get out at the pivot profit zone, Raymond? What day? Monday, Tuesday, Wednesday? Yeah, well, isn't it interesting though, Raymond, that I told you, even though there was nothing on the chart that it said it predicted that move, that I felt very strongly that it was going to do that. So Tuesday, but you can tell the client, you can say, well, I see a massive event risk between Wednesday and Wednesday. So therefore, I hit targets early. I didn't panic. But I did see the risk. I adjusted our positions for the risk, and I took risk off the table. Okay, you see what I mean? Well, Anthony, I know what you're saying, but I actually disagree with it, Anthony. Anthony's like, there's no such thing as a small profit. Yeah, when the market moves 500 pips and you make 50, it's not a good trade. You mismanaged it, right? Okay. Okay. But if Raymond got out with 200 pips and 1 week from now he could have made 500 pips, see, that's different. I'm not interested in coulda, woulda, shoulda, and all that kind of stuff. Because I'm not looking at it as this trade or today. Think of it over a lifetime of career, and especially if Raymond's managing millions of dollars. There is risk. I talked about it yesterday. I'm talking about it today. I talked about it Monday. I talked about it last week. I talked it all through Forex.Today, but also in the private group. There is risk on the table. It starts today. So I don't care if it drops 300 pips or rises 300 pips. If you get out, you just simply recognize the risk, which is way more important than anything else, and manage the risk. So you either moved your stops closer or you just did the law of averages and just simply got out for profit. And then after that, everything is irrelevant. Because if it jumps 300-400 pips, it means it could have dropped 300-400 pips. So I'd rather you just have no risk. That's what your clients want, guys. They want low volatility and consistent returns. So if this jumps 300 or 400 pips between now or non-farm payrolls or the Fed meeting, and you go back to this trade, you're like, oh man, if I only stayed in it, I would have been up 300 or 400 more pips. No, you would have had volatility. Okay? And as Alex says, there is another trade. And it's probably a better trade anyways now, right, Ali? Right, Ali? Alejandro's like, yeah, there's always another trade. And it's always better than the one you're about to take. Because by the time you set it up, something better is probably happening, but you're not looking at it because you're focused on the one you're setting up. Okay? So get in the trade right. Have proper risk reward. That's if there's no reward, don't take the risk. And then what? Then manage the risk. That's all there is. You should always take a little bit of risk for a lot of reward. And if risk increases, you don't like it. So if Raymond gets out right between the Wednesdays, well done. The other choice would be jam a stop and look at it as a new trade. You're like, well, I either make 200 pips or I make 500 pips. There's only two scenarios. Okay? And he might be up 250 at that time, so it's just really a new trade. It's a new 50 pip stop, basically, right? So anyways. All right. So how exciting was that Bitcoin trade yesterday, huh? As soon as I shut down the webinar, I went and made a cup of coffee, came back, dropped $500. I'm like, ooh. Remember we were on like a 1 minute chart trading this? I'm like, wherever it was, I can't remember. I think it was back in here. Anyways, we were right here, right? So no, it must have been here on the high end. Anyways, whatever. It was funny. Yeah. Okay, here's Aussie. This is the most bullish one we've had for a while. We've been planning it out. Here's a level of risk. Now, remember, I drew this giant X and had probably a 20-minute conversation with the group when we were here. Do you notice none of this says down? Where were you on Sunday when the market opened? Okay, my message to people in here was don't miss it. It's not going to give you a good price like usual. So we talked about, like, if you're looking for a bargain, if you're looking for a good price, I think this month you won't get it. That was the whole conversation on Sunday night. Like, yeah, I get it. If you're a bull, this is the buy zone. You want a good price. You're probably not going to get a good price. So don't trade a monthly like you normally would trade a monthly. You know, it's not going to be like last month or the month before. So how do you trade it? Well, drop into your weekly or even daily. I said don't miss it. Day trade it. Look at every little day trade. And this is going to go up hot and fast and hit monthly targets early. Crazy, right? It's custom made. But if you go to MetaTraders, you can have it for $5. MetaTraders.com. All right, links in the description below. All right. So what you could do then is say, okay, I got you, Wayne. So you start here and you're like, bullish. That's your bias. This is what we were here. Bullish, bias, great on high time frames. Now let's go into a small time frame. Okay. Okay. And now you can see why I was thinking dips. But even that is moving hot and fast. So even pivot points are not, daily pivot points are even not really, I mean, they're happening so early. So let's put it this way. When we started trading here, we already had this pivot hanging here. You understand that? See, we're looking at tomorrow's buy zone. This is tomorrow. This is Thursday. I'm not interested in Wednesday. It's Wednesday now. Why would I just be making a trade plan now? So some of you new guys, I want you to think about this. New York is just opening on Wednesday. Why would I just be coming up with a trade plan for Wednesday now? It's mentally deranged that you're walking in and you're like, what's going on, bro? Are we buying today? Like, that is so scary bad. Right? What you're supposed to be doing right now is planning tomorrow. Okay? Cool. So when we were here, we already knew you were a bull on the monthlies and the weeklies. Okay? So cool. So what are you expecting on your day? You expect a higher high. Why? That's what bulls expect. That's why they're bullish. Okay? So how about this now? You ready? So you get a higher high fairly early in the day. And by the way, look at these wonderful markings. This is your conservative target on Monday. Here's your aggressive target on Monday. Okay, cool. So now what do you expect to happen now that you've hit the targets for the day? What do you expect to happen? You're a bull. You just got your higher high, which you traded. Why? Because you expected it. Cool. Or even if you didn't expect it, now what do you expect? Even if you didn't know that. Now you got it. You got yourself a breakout. So what are you going to do about it? What's the next thing? What's the new thing? HL, higher low. Okay, let's see. Where could we have a higher low? Well, it could be in this area. It could be off the future 21. So remember here, the 21's down here. Here's the, right? But here's the 21 throughout that period. So the 21's catching up. Or the new 5A cross up. I mean, it doesn't matter. I'm sure there's an oscillator in here. If you've plotted an oscillator, there's like a bajillion ways of getting into this trade. What's holding you back is you don't know if you're a bull. And you're not using tomorrow's pivot points. You're still on today. Today's done, bro. Today is done. You think a professional walks in and they don't know what they're doing? They're like, hey, I guess I'll use a London breakout. What the hell is that? I'll wait for London to do what it's going to do and then I'll do that. Like, what are you, living off scraps? You can be a bull or a bear, but you can't be a rat living off other people's scraps. Oh, look, a crumb. I mean, come on. Gee whiz. Even the idea, like the sales pitch, is so stupid. Okay, cool. So you made a higher high, so you're going to buy a higher low. Okay, good. But you see what I mean? Like, your plan, execution. Now you're planning the dip. Great. Execution. Plan. Great. Execution. So on and so forth. Okay? Check this out. You know to ride the 21. You know that. This is like Boot Camp 101. Okay? And what does this mean? This is a shields up, red alert a moment. Shields up, red alert a moment. Okay? You're not supposed to be drifting between the 21.55. You're not supposed to have a low that's low. But also, what's in front of this? What's in front of this? I predicted down here that you should exit here. I even threw an X for crying out loud. So all of this, okay, you could have made a few more pips, but who gives a crap? Now you're not even in this market anymore. And under these conditions, there's a lot of risk. Okay? Let's take a look at this in a different fashion. Oh, I don't want to do that. I want to do this. Let's do this. Let's mark this up a little bit. Let's go monthly. Let's put the big M on, man. Get your M on. Okay. Oh, look. That's why this is not a coincidence. You see? This pivot here, this pivot here. That's why I already have it X'd out. So on Sunday, let's put this together. And really on Sunday, you can do it earlier. But on Sunday, I analyzed the monthly pivots, the weekly pivots, and the daily pivots, and asked myself one thing. Does this technical analysis confirm or deny that market conditions are favorable to my bullishness? Does my technical analysis confirm or deny on multiple time frames that market conditions are favorable for me? Okay. Right? You have to fold that, right? Well, by the way, still above the 21 and the 4 hour, whatever. So that you got to analyze that, okay? You have to analyze that. This says in the short run, this is not favorable. Maybe in the long run, but you have to also interpret in here that I'm worried between the Wednesdays. Between today and next Wednesday. I think there's a lot of risk. And let's put it this way. If you look at sort of what happens in January, February, March, April, May, June, July, August, September, October, November, and December. So we did this in the swing trading group in one of the training courses. And I said, let's go back through time and see how often we blow through the pivots. Was it fairly rare or was it fairly often? So here's what I say then. Here's what I said 10 years ago. Here's what I said 15 years ago. Here's what I said 2 months ago. Your job is to exit. What happens next is irrelevant because this is rare. It happens for sure, but who cares? Do you know what rare means? Risk. Okay? Now, I happen to predict it here that we were going to have a big, hot, and fast month. So it's predictable. But the thing is, if you do this January, February, March, April, there's a May, I don't know what this is. May, I guess. June, July, August, September, October, November, and December. If you behave consistently and simply exit where you should logically exit, then you are very consistent in an inconsistent market. And you're just done. You got the easy pips. Is there anything to be embarrassed about? Right, Raymond's got it, the law of averages. So should Raymond be ashamed? Because he bought where you logically should buy and exit where you logically should exit? That takes discipline. What happens next? I really don't care. Because if you do the consistent move based on your logic and intelligence, you will get your consistent behavior will produce consistent returns. And if you make money, but you don't suffer wild pullbacks and wild expansions and then wild pullbacks, what happens is you take all that volatility because you're only trading in market conditions that are favorable, and you're entering logical places and exiting logical places. Okay? You assume less risk. You're not doing rare, wild trades, and you'll end up with consistent returns with low vol. If you can do that, you will have a career. Whether you take care of your family or you take care of someone else's family, meaning your money or someone else's money, okay, you will be successful. Okay? This other stuff beyond this, leave that for the pigs. You know that bucket of slop you feed the pigs? That's what that is. If you're trying to get rich quick, it ain't going to happen. It's a fool's errand. It's a mirage. It's fool's gold. I want you to look at working long periods of time, years and years and years, having patience and discipline to execute your skills. Okay? Don't even look at it as getting rich. You are providing a service. If you mow lawns for a living, then you should mow them beautifully. And you should love mowing lawns. You shouldn't be embarrassed about it. If you're embarrassed about it, let someone else do it. You should take pride in the work that you do. And every single time you mow a customer's lawn, you do the best to make it beautiful. You make sure the flowers look wonderful. You leave a thank you note. Okay? Every spring, even though no one's paying for it, no one's asking for it, you plant a few pansies. It costs you $3 to get some pansies, but people are like, damn, I got the best mower. But the thing is, you show up every time and you mow it beautifully. There's nothing, right? That's that. That's all we're doing, guys. And you're going to mow it every week, and you want to keep that customer for years. That's all we're doing. Doing the absolute best we possibly can with our skills. And we love what we do, and we take pride in what we do. Everything outside of that, you know, is where people lose money. You understand that? Where do people lose money? In the stuff that's not easy. It's this other stuff, this other noise. They're selling in an uptrend. Well, that is dumb. So once you get past that, then what are they doing? They're still trading up here. Okay? And what you have to learn is, if you miss these pips and it bothers you, you have a little more to go, because what you don't realize is this will lead to loss. Because you're not in it, you see it as money you made. But I know people didn't make money because it went up and it came back down. Okay? So if you had, put it this way, if you didn't have the discipline to exit here, which we knew way down here, if you didn't have the discipline to exit there, did you exit here? Absolutely not. Because you have no idea what's going on. And even if you did, you don't have the discipline like Raymond has. Okay? And then what about those that shorted here? Oh, you shorted in an uptrend? Oh, good. So they'll make money this time, and they'll lose money next time. And what you don't see is, over the course of the year, they made money here, but at the end of the year, they're broke. Why? Because they short uptrends. It's like the dumbest thing ever. Okay? Hey, if you short a double top, lower low, lower high, not dumb. Okay? Okay? Remember this. Picking Picking tops or bottoms. Okay, so we'll use the opposite here. Picking bottoms is a strategy that is guaranteed to stink. Picking bottoms is a strategy that stinks. Think about it. You might be able to remember it. Okay? So, again, the trade you're not in is always the profitable one you should have had. If you didn't have the discipline to get out here, you didn't get out here. And if you're a bear and you shorted a higher high simply because of something, and you basically gambled it was coming down, it's not that you're a bear that's a problem with me. It's that you took the strongest currency pair on the planet and you shorted a higher high. That also will lead to poverty. So this person doesn't have discipline. This person's the gambler. And at the end, they're both going to lose. So I'll put loss up here. And our buddy Raymond's like, oh man, I got out here for profit. I took the easy trade. I made the logical money. And I'm like, dude, well, here's what you need to learn. If you didn't get out before that, you would have lost money. If not on this trade, on some other trade, because you don't have the discipline. Raymond does have discipline. Okay? And the right thing to do was here. This is the money. And now you're profitable with no risk. These people up here are going to blow up their trading account someday when you're all alone and the world is cold. Macroeconomics ain't going to save you, buddy. I understand why he's bullish because of all this cheap dough. No, this actually is a balance of trade issue, KG. This is a balance of trade issue. So what was it on Thursday when we did our group meetings? One of the things we talked about after each group discussed their technical plans based on their fundamental bias, each group came back to the main room and did a presentation in front of everybody. And I think it was Julie. In hers, she was talking about, might have been this one too, in Aussie yen. And she had downloaded data about two things, at least two things, Australian GDP and Australian something else. But anyway, so because she brought that up in my feedback to her group, you know, I looked at the GDP part, right? So the C, the plus the I plus the G, G plus the X and minus M. You know, we had talked about this relative change in X being the most important part of this. Okay. But this isn't cheap money. This is macroeconomic activity. Okay. Oh, yeah, and she got it right. There's no doubt. Good planning. I mean, she had done the analysis, wrote things down, had multiple, could offer multiple citations for fundamental data. She put that together in a bias. She and her team marked up the Aussie yen chart, had multiple entries, and yeah, that's what we do. And the interesting thing about that is that's just simply the job. Well, the change actually occurred a couple of months ago, KG. Okay. And guess what happened in here? I think there's two ends, right? Anyways. Try to reopen. And then we saw this in the balance. of trade data, the X minus M was favorable. There was an increase in demand for Aussie dollar relative to their imports, and the valuation increased. Just macroeconomics. But it wasn't even the guess that China opened. We looked at the actual data. This was actual data. Okay? So again, on Thursday, we looked at GDP for Australia, and we're breaking down the X minus M factor of GDP. Okay? This was down, which is bad. This is up, which is good. And so you're like, the Australian economy is horrible. Yeah. But there's demand for the Australian dollar. That's irrelevant to the economy. This is relevant to other economies, which means Forex is relative. Okay? This was your China play. Yeah, well, KG, what I'm saying is they were doing that in here. Sasson, let me ask you something. If 10 Australians are standing in the road, like, in fact, I heard a funny story where a man comes up to a hotel and he's like, I'm looking for a hotel room for tonight, but I want to see the room before I make a commitment. And the hotel manager says, well, leave me $100 in cash and I'll give you the key to the room. And if you don't want to stay here, I'll give you your $100 back. And he says, okay, that's a fair deal. So he puts the hotel $100 on the counter and goes upstairs to check out the room with the key. The hotel manager runs across the street, pays for something he owed money for, and that person now has the $100, and they go pay for something, and they go pay for something, and in fact, it goes all the way down to a prostitute gets the $100, but she owes the hotel $100, so it goes all around the town, and then she pays back the $100 back to the hotel manager, and she leaves, and the guy comes up from upstairs, and he says, no, this room is terrible. I don't want to stay here. So he puts the key down, takes his $100 back, but now the town doesn't owe anybody any money. Right? Everyone paid their debt, and it went all the way around, and then the guy got his $100 back, and now everyone's like, woohoo! Right? And the whole town went from broke to break even, right? And the joke was like, that's what central banking does. But if money goes around, like the velocity of Australian dollars goes around in circles around Australia through the Australian economy, it doesn't impact the Australian dollar. It doesn't matter. That's why I keep telling you, news is not fundamentals. Okay? So an Australian wants to pay 3% less for a brand new house. Doesn't matter about the Aussie dollar. Okay? If an Aussie buys 3% less gasoline than he did a year ago, doesn't matter. Doesn't affect the Aussie dollar. Okay? What does affect the Aussie dollar? You have to think global macro. Same store sales of a coffee shop in Australia is up. Does that mean demand for Aussie dollars up? No. Means the velocity of money is up. Okay? Import-export, guys. Money changes valuation when it crosses a border. If money doesn't cross a border, valuations do not change. Because here's the thing. Okay? Let's say you buy my house. You give me money. You had the money. Now I have the money. And I used to have a house, but now you have a house. How much has the currency changed? Nothing. We just swapped assets. Cash is just an asset. A house is just an asset. Most people don't own assets. They just own crap. Right? What's the saying? Poor people own a lot but control nothing. And rich people own nothing but control a lot. Okay? So anyways, if you just exchange assets from your neighbor, it doesn't impact the currency at all. None. Okay? But relative to another economy, if money flows from this country to that country, then this one goes up because it's appreciated. Demand for Aussie dollars gone up, and the supply of yen has gone up, which lowers the value. So let's just do this quickly just to make sure we're all on the clue train. I'll do it briefly because I know most of you are. Okay. Demand, supply, quantity, and value, but I'll say value. Okay, so this is a demand. Cool. So if China wants to buy stuff, anything, let's say iron ore. China wants to buy some iron ore for their economy. So they're going to need Aussie dollar first. So I have to label my chart properly. So this is the value and the quantity of demand, right? How much demand, okay, for the Aussie dollar. Okay, so China decides they want to buy $1 billion worth of iron ore and bring the iron ore to China. So they're going to have to buy Aussie dollar to buy Australian iron ore. Demand for Aussie dollar goes up, okay? And we move from equilibrium 1, okay, quantity 1, to equilibrium 2, which is quantity 2. And you'll see, in fact, the demand for Aussie dollar went up. That's quantity 1 to 2. The units of demand have increased. Okay? So you can say units of demand. 1, 2, 3, 4, 5. So anyways, moving left to right, there's more. Okay? Now, extrapolating this further, in the first equilibrium, okay, we were here. And this is the value of the Aussie dollar, value 1. Now, in the new equilibrium, only because demand went up. Okay? Only because of that, now we're at value 2. The value, the purchasing power of this Aussie dollar has increased. So the value of the Aussie dollar went up with increase in demand for the Aussie dollar. So if China's buying iron ore and coal from Australia, they need to get Aussie dollar first, so they demand some Aussie dollar, and the value therefore went up. Cool. Now, let's change this up. The Chinese buyer actually wants to use leverage. Yeah, boy, love that leverage. Oh man, I killed everything, huh? Can I undo that? Okay. Anyways, I'm trying to get this. I guess I can just do the whole thing over. Okay. And it's not Aussie anymore. Let's get rid of that. That can stay. Let's do that. Let's do that. Let's do that. Let's do that. Okay. So now we got to change it up a little bit. And I'll change the color a little bit. So now we got demand. That was supposed to be straight, by the way. there's supply, and this is for yen. Okay? So what they do is borrow Japanese yen, let's say 100 to 1, so instead of a billion, maybe they have 100 billion, or they get a billion, but they only pony it up 100 million to get it, or even, I guess, 10. But anyways, so this is JPY. And so they go to JPY first, borrow that, and then they convert that to Aussie dollar. Okay? And then with the Aussie dollar, they buy the currency. So that's JPY, which means, right, the quantity has to shift. Or that, in this case, the quantity or the supply shifts from S1 to S2. The supply now, because remember, the Chinese buyers borrowed Japanese yen. They took a loan. And then they swapped it, right? Swapped it for Australian dollars. So there's less Australian dollars in the world, but there's more Japanese yen. So we now have an old equilibrium point. So this is actually Q1. Okay. And a new equilibrium point, Q2. So now the supply, the quantity of yen in the world has gone up. But what happened to the valuation? Well, we were at value 1 for Japanese yen, but now we're at value 2. The purchasing power of a yen has gone down with the increase in quantity. So all we are playing here is this. Okay, there's two equations. There's a supply side and a demand side of the equation. And they're all relative to each other. Let's do it this way. Let's just do confluence. Anyways, so what we're doing, going back in time, is we're watching this data and changing our fundamental bias. Okay? And we're looking at this and looking at this. Okay? And if you recall back in here, I'm telling you, there's a dichotomy between the market and the economy. You guys remember that? I said it every single day. Every single day, there's a difference between the market and the economy, and everything we're doing here represents 6 to 12 months in advance. So if you say to me, well, everyone's dying of COVID-19. Yeah, I get it. Will they be dying in a year? Maybe. But if you don't think so, time to buy low. Now, you extrapolate that with more fundamental data. Right in here is China opening and an increase in X for Australia. So X went up, odd went up, and it was all funded in yen, so yen went down. And how do we explain this phenomenon? Okay, D went up and S went up. So therefore, the value of the Aussie went up and the value of the yen went down. Simple economics. And do you understand? We've been talking about this for weeks, months. Okay? That's that one pair. Let's change it. I won't even change my chart. Well, actually, let's do this differently. Let's go into a 1 hour. Let's go back to the 1 hour and let's change. Oh, damn it. Actually, that's probably a good sell. Anyways, wait, I might want to leave that. But no, I don't want to sell this. That's the issue. I don't want to sell this. Hang on, gotta cancel. Probably a good trade though. I want to change the template. Let's do this. Okay, cool. Let's do this. I won't change anything here except the currency pair. Okay. This is nice and up. Beautiful trading. Okay. Way outside the pivots. Let me change the pivots now, though. This should be set on monthly, and that's weekly. Yeah, okay. So let's go back for like the expected move of the month. Okay. Here's what we expected on the first day of the month, which is right here. Okay. Bulls are buyers in here. Wait, that didn't print right, did it? No, let's change. Let me clean this up. What the heck is this? There's like a dead pivot in there. Anyways, that's weekly. So, is it weekly? Hang on. What the heck's going on here? Well, let's delete that. It's not printing right. So what is this? It's like an old dead pivot. Huh! There's no pivot point indicator on my chart. I'm like, that doesn't make sense. Well, luckily I can see that. All right, well, that's weird. So, well, anyways, let's go back to what I was doing because we actually know what we're doing. So let me go back and, well, let's just change it this way. I got to go back to a template. Hang on. Let's put this on a monthly. Okay, cool. So check this out. If you're a bull and you're buying higher highs and higher lows, this is the buy zone for the entire month, which, by the way, you knew easily a week in advance. You also knew this was the target for the month. You see that? So this goes for everybody, including my seasoned, trained traders. This is important data. And this is important data. Does it tell you what to do? No, you're the one that does that. Okay, you understand? Is this helpful, relevant information? Only strategically. Don't get caught up of having to do something because it's there. That's no, you're not thinking strategically in that case. But now imagine you're doing like trading London Opens on a 5-minute chart. Do you understand all those trades are inside to this? Up, 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 down, down, buy, up, 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 down, down, buy, up, 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 down, down, buy, up, 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 down. They're all living inside of here. Okay? So when you're trading price action puts you into trades, right? PA gets you in. Okay? But that's all tactical. There's no strategy to it. It's tactical. You have to know how to kick down doors. You need to know how to fire your rifle, throw a grenade. Okay? Basic rules of engagement. But isn't it interesting to know, even back in here, even on the 26th of May, that this is where you're going to exit? And then, of course, me as your coach, we're right here. And I'm like, this is going to go up hot and fast and hit the target early. And between the Wednesdays, you shouldn't be shocked if there's a dramatic change in trend. So we double top it on Wednesday. So these indicators being like pivots, which is market, not price, market, and fundies, they're leading indicators. Otherwise, how the hell did I know this? Down here, we had a 2-hour webinar, I think, right in there. How the heck? Well, fundies. Had nothing to do with the chart. And then what about pivots? Well, they predict good buy zones based on trends. Now, if you don't have a trend, you got a problem. And they offer decent exit prices, okay? So once you got all that established, now you drop into the price action. You know what you want to do, and you know where you're going, and you know what you intend to do when you get there. And what do other people do? Trade in fear and panic, or arrogance, which is even worse. Okay? Oh my God. Check it out. We're going to hit the target hot and fast early in the month between the Wednesdays. And on the first Wednesday, we hit it. Oh my God. Becky, look at that trade. So if I don't have a crystal ball, then there's something in here that's interesting that doesn't live on the charts. Okay? Now, if you're a bull, you know this is a pretty dumb place to buy. And if you're a bear, I think if you sell this, you're pretty early and probably too aggressive. Hard drop coming? Maybe. I didn't say that. I said there's increased risk coming. I think more likely it would be, okay? Okay, that's all. But I don't know. All I know is there's increased risk. But you have to understand this move here was not macro, was not fundies, and was not technical. So how the hell did I know that? It was not macroeconomics. It was not fundamental analysis. It was not technical analysis. So how the hell did I know that? Not only the direction, not only the price, but even the velocity at which it will hit. Not price action. There's nothing technical that predicted that. Not seasonality. I mean, a little bit. Illuminati? All right, so I do have a lamp. Thank you, Harvard. It's an E. So I talked about it for maybe 45 minutes with the private group on Sunday of why I thought it was going to do it. It has to do with humans, not computers, not not data, not algorithms. Human behavior. And the decisions that they're going to make because I know the decisions they're trying to make. I understand the decisions that have been put in front of them, and I can predict what outcome they're likely to make. Because people is smart. Okay? People going back to work? No. I've lost significant confidence in the Great British Pound, in particular the Bank of England. I'm very, very disappointed. So it's not that I think the pound's going up. Okay? Okay? It's humans, guys. Now, I want you to look at the calendar and say, what the hell is he talking about between the Wednesdays? What does that mean? Well, why don't you look at what's going to happen between the Wednesdays? Like, figure it out. If you need me to spoon feed you, you're never going to get there. I want you to dig into that and say, son of a biatch, what the hell is he talking about? And why is he saying it's so important? Like, what does this guy know? I don't know any more than you. I have the same access to the same information. So figure it out. Open an account or open a calendar and say, what the heck is on the calendar? What does he mean? And why would it, what would move humans to behave? And like, what decisions are they making? Like, figure it out. It should be like a tick in your brain. Like, you're like, I can't sleep until I figure this out. He just gave me a puzzle. I have to figure it out. Okay? I've spent days trying to figure out a math problem. And I've actually solved the math problem while I'm fast asleep, because while I'm sleeping, I am still working on the math. And I swear to God, this is absolutely 100% true. I woke up at like 3 o'clock in the morning and I'm like, I have to write this down. I figured it out. I have to write it down. It's 3 o'clock in the morning. I woke up and I wrote down the answer on a pad of paper next to my desk and went back to sleep. Woke up in the morning, went down, looked at the math, did the calculations, and I got it right. Why? Because I have to get it done. I have to figure it out. You should like, oh my God, this should just drive you batty. You got to figure it out. You got to push harder and further. Break the line. You got to get at least 1 inch ahead of the other 95% of traders in the market. Okay? You only have to be a little bit better than the other 95%, and you're golden. Okay? Or figure out limit orders, right, Brad? But yeah. So anyways, this move here, I discussed for 45 minutes. It's not technicals. It's not fundamentals. It's not macroeconomics. It's not import-export data. It's not an announcement by the central bank. None of that. This is just humans. So you have to understand the decisions they have to confront and the likely decision or and the decision they'll make. Okay, that's it. Human behavior, guys. It's just that easy. Coolio. All right, gold coming down, very nice. Bitcoin coming down, very nice. Euro dollar going up, really nice. I mean, we spent a lot of time yesterday, wasn't it, on euro dollar? Just gorgeous. These are just gorgeous trades. Okay? Let's try to figure it out. You're like, Wayne, that's a lot of lines. I don't really know how to trade pivot points. I don't know that kind of stuff. I'm like, okay, well, let me change this for you. I am going to put this daily pivot points bullish, okay? And I'm going to open this up. I'm going to go to the thing. Hello. And we're going to plot 55 days of trading. And those green zones are buy zones. That's a buy zone, that's a buy zone, that's a buy zone, that's a buy zone, right? And then it makes a lower low. Hunker down, man. Back off. We don't like lower lows. It's now another lower low. Back off. We don't like lower lows. But Wayne, it printed a green zone. Pivot points don't tell you what to do. It's moving down, don't buy. Okay? Now we get a higher high, higher low, buy that. Higher high, higher low, buy that. Higher high, didn't pull back. Higher high, higher low, buy that. Higher high, higher low, buy that. Higher high, higher low, buy that. We're making a higher high now. You're like, now. Yeah, well, we already knew that. We knew that yesterday, bro. So why would I care now? Because here's what's going to happen in the next 12 hours. Okay? See? Just that complicated. Buy dips in an uptrend. You got this, brother. You got this, sister. You can do this. You can do this. Simplify, 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 simplify. Why is the euro dollar going up? Nothing to do with the euro. This is a global macro play. That's it. Dollar's weak. Why? You're going to have to watch videos from 2 weeks ago. I explained it in great detail why this was going to happen. Not only were we given the actual data, the data was pre-released. Pre-released data before the data to say all of this was going to happen. And if you're like, I don't know what he's talking about, well, there's your weakness. We need to fix that. Because the powers that be made this obvious. Slap in the face, kick in the shin. If you don't notice a slap in the face and a kick in the shin and someone stomping on your toes, then you got some big problems. Okay, you might not be sleeping, you might be in coma. That's what happens. This data is that important. So like the X going up relative to the M in Australia, if you missed that, you might be in coma. If you missed why this is happening and you're looking at it, you're like, oh, well, but German consumer confidence, like, come on, dude. No, seriously. Okay? This was given to you on a silver platter. Well, even before then, Daniel, it was even pre-released, but I had talked about that multiple times. So what I'm saying, guys, is I think you're probably overcomplicating this. I think you're trying to be too smart. I think you're trying to be too clever. I don't know you, and I don't know what you're doing, but I have a hunch that you're making it too complicated. Why can't you just say the 21's above the 55, therefore I'm a buyer? And where do buyers buy? Do buyers buy high or do buyers buy low? They buy low. Well, that's low. There's a higher 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 low. And maybe in the future there'll be a higher low. Like dumb it down. You've defined using nothing but a 21.55 that on this time frame, this currency market is bullish. Done. So you buy dips. What does my book recommend? In this scenario, you buy pullbacks to the 21. There's a pullback 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 to the 21 today. Now it's up. Like, simplify. This is easier. What I'm showing you now is easier than what you're probably doing. You understand? So either you're making it more complicated or someone else in the YouTube world is making it more complicated. Either way, either you're trying to look smart or they're trying to look smart. But smart people make complicated things easy. Okay? So I want you to focus on making it easier. I know you can do this, but stop trying to be so smart. Right? Well, so Meta's like, I'm trying to be tired of being seated on your hands. Well, so this is a much bigger conversation, Meta, and one that nobody likes, including myself. But there comes a time when you have to, in this maybe feeling, reaffirm your bias. Why are you bearish? And remember, the most important question to always ask is, why am I wrong? Not why are you right? You made a decision, so you're either right, and you already know why you're right. But like, the hardest question for me is, am I wrong? How do I know when I'm wrong? Okay? And I'm not saying you're wrong, but when you're in that situation, maybe spend a day or two going back through the analysis and say, you know, why am I sitting on my hands so much? Is it a good thing? Is it a bad thing? Have things changed over the last, because here's like one thing that could possibly happen, right? You can go from patient and disciplined to stubborn. And again, I'm not saying this is you. Also, there's the other side of being stubborn is the frog in the pot of water, and you put him in the warm water and he's cool, he's liking it. And then you turn the heat on really, really low and it gets a little warmer and a little warmer and he never jumps out. Of course, if you just drop him in boiling water, he jumps right out. But if you just turn it up slowly, 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 right, he never jumps out and he boils to death. The hardest question to ask yourself is, how do I know I'm wrong? And when will I decide I'm wrong? Now, the cool thing about the way that, you know, I teach you to be wrong is that you're not going broke being wrong. I know, Meta, you're patient. I know you're disciplined. So you're waiting for your time and all that kind of stuff. But what if you got the bias wrong? I'm not saying you have, but we all have to be very sensitive to this. Of how do you know your bias is wrong versus the market conditions being unfavorable? Okay, and so I'm not commenting on anything, except we all have to have that sort of that card somewhere on the table, right? And that's the toughest one. And the smartest, most disciplined of all traders know that they have to ask themselves that sort of ugly question, right? What if I'm not being patient? What if I'm missing this, right? What if my bias is wrong? And I would just start over and redo the bias. Right. Yes. And that's good, right? That's a good thing. What I'm saying is you're doing everything right. And it's difficult. Yeah. Now, if you take your bias out further, right, there will be times, no matter how wrong you are, if you're wrong, there will be times when the market will sit up. Okay? And then no matter what trend is happening, right, bullishness will turn to bear and bearishness will turn to bull. But the fundamental bias part can last years. Right? The fundamental bias part. I'm not when I say bulls will get opportunities and bears will get opportunities, that's technical analysis. But a fundamental bias can last years and years and years. Okay. Okay. I will likely be a dollar bull when the Fed cuts interest rates. So there are two scenarios when the Fed cuts. Let's do it this one. Let's do it this way. Come on, eraser. Let's do it this way. Okay. The Fed will cut when there's a new market crash. Okay. I don't mean stock market. So let's say stock market. So for the stock market to crash, nobody's making money because nobody's spending money. The C in GDP drops, the I in GDP drops, the G in GDP goes up, the dollar gets strong, export falls, X falls, but also M falls, and GDP just looks like a mess. And the Fed cuts interest rates, probably has to go negative, and the dollar gets unbelievably strong. Or two, stocks continue to go up. We finally get some level of inflation. And interest rates rise. Don't get lost here. Rates rise. However, it's not the raising rates. And then, so we have a long period of time. Could be 5 years, could be 8 years, could be 10 years. Listen to me. This could be 10 years. And then we get to a point, right? So 2.B, Fed stops their policy of raising interest rates. Okay? And that will be the day I buy the dollar. So let me redraw this. In that case, the market comes down again, and you get back into mode number one, and USD goes up. So I don't know how long I'll be short US dollar. It could be 3 months from now, we have a stock market crash, and I buy the dollar. Or in 10 years, or 5 years, or 8 years, or 3 years, or 6 months after the US election, we have a major correction in the stock market. Well, when I notice that, I know how the Fed will interpret that, and I know the policies they're likely to implement, and I know the consequence of those policies on money flowing across borders, and I know how to make money in the foreign exchange market. I'm not joking where I could be long, I could be short US dollar for 8 years. Day after day after day after day, week after week after week, month after month after month after month, quarter after quarter after quarter after quarter. Well, now when you start talking about quarters, well, then I know there's some seasonality to that. And when I'm saying years of bearishness, I also know there's long-term cycles, there's annual cycles, there's 8 to 10 year cycles. So I'm doing these cycles, and on top of that, there's super cycles, which are like 100 years. Right? So I'm taking all this, and what am I saying? I'm saying, okay, I want a short dollar, which means euro dollar goes up. So let's say October 12th. $2023. I'm going to look to buy the euro dollar. All else being equal. So my play right now is the Fed can't cut any lower. They won't cut any lower. What will they do? Well, they'll increase money supply. What will happen there? There'll be more supply of dollar. The value of the dollar goes down, and I'm already short the US dollar anyways. I'm short today. I'm short tomorrow. I'm short next week, next month, next year, the year after that, and I can tell you, all else being equal, meaning nothing changes, if the Fed doesn't cut interest rates, then on October 12th, 2023, I will be buying a dip if the trend is up, if market conditions are up. I will buy a dip, I'll buy a higher low on the euro dollar on October 12th, 2023. I'm done. I've simplified it as much as I possibly can. Can you be fundamentally risk off and then the market's bullish? Well, why are people taking on risk if the market is off? See, that's where we got to be careful where the market is 6 to 12 months in advance. And by the way, many of the crashes actually, like the COVID is a unique one, but the Forex market knew about the 2008 crash. Shoot, we knew that in 2007 and we're trading it. We knew 6 months to 12 months in advance. I was predicting specific days 3 months in advance. Does anyone remember that one? I remember the one where I'm in Spain. I'm speaking at the FX Street conference, live in front of a group of people. I'm on a panel discussion with experts. And the audience is like, help us, because it's 2007. It was about to be the end of the world. No one wanted to give a prediction. I said, I'll give you a prediction. I'll tell you the exact day. Well, not exact day, but here's what I said. I said, the market is freaking out, and the Fed is telling us it's just a subprime problem. The English are telling us it's just a problem with the Yanks. And I said, but smart money is getting out. I said, in fact, smart money have been buying 3-month treasuries. In fact, the largest purchase of 3 months treasuries in the history of the world just occurred last week. So think of this. This is in 2007, guys. Probably August of 2007. And I said, just recently, we had the largest purchases of 3-month treasuries in the world. The stock market just crashed. People took all their money out and stuffed it into 3-month treasuries. And I said, in 90 days, at the end of 3 months, they will have to make a decision. What should they do with their money? Should they buy the dip in the stock market and the financial crisis is over and subprime problem has gone away? Or is the market still unbelievably frightening? And if it's unbelievably frightening, they're not going to get in. They're going to roll their investment into treasuries over and buy another 3-month treasury. You get where I'm following you? So I said, the pound yen 90 days from now, sort of in that window, because I don't know the exact day when each investor bought 3-month treasuries, but they got out of the stock market and they bought treasuries to hold their cash. And then, of course, they wanted to buy the stock market back because this is what they do. They're long, short, right? They're long the stock market. So they just want to get out while things are horrible. And if things are good in 3 months, they're going to take the money out of the 3-month treasury and stuff it back into the stock market because they'll say the worst is over. Okay? So guess what? I said in about 90 days, the pound yen is going to drop 5,000 pips. By the way, I don't mean these micro pips you youngins talk about. I mean a drop from 150 to 140 is 1,000 pips. So it'd have to drop from 150 to 140, from 140 to 130, 130 to 120, 120 to 110, 110 to 1.0. Like, unbelievable drop. Years and years and years of price action is going to happen 90 days from now. It'll do it in short order. Instead of taking 6 years to drop that much, it's going to happen in days and weeks. And I was wrong. It dropped 7,000 pips. My bad. Okay? But that makes sense, right? Like, what I'm trying to explain to you over and over and over is this is logic. This is people. This is human beings making a decision. They have $1 billion stuffed in the stock market and a financial crisis hitting and banks are failing. So people investing in stocks pull their money out and they stuff it in a short-term bond. That's all it is. The stock market goes down, bonds go up. So they buy a bond. It's not really a bond, it's a treasury, but it acts like a bond. And they just simply hold it. It's just a place to put the cash because they can still earn a yield. So they just get it out and they're like, okay, I have a safe haven here. I can hold this for 3 months and not lose money. And in 3 months, I can come back and see, are things better or not better? And if things are better, I'll get out of that treasury because it'll actually expire and you get your cash back and then you buy the stock market back. Why? That's what you do. Your job is to buy the stock market. So in 3 months, the treasury is about to expire and you look at the market and you're like, it's horrible. Blood in the streets. End of the world. Banks are failing. What happened to Lehman? What happened to Bear Stearns? Like, oh my God, what do I do? I don't want to buy that. So you buy another 3-month bond. That's it. But that predicts everything. That's human behavior. They're not buying the stock market, so the stock market can't go up. But what if foreigners are doing this? What if foreigners are bailing on the British stock market, right? The FTSE's coming down. The CAC is coming down. The Nikkei is coming down. So what do they do with all that cash? You're a billionaire in Malaysia and you're like, do you stick it in a Malaysian bank? They're like, hell no. So what do? You buy a US treasury. So while everything was crashing, pound yen went down, but also pound dollar went down. The dollar got strong, the yen got strong, the Swiss franc got strong. Why? We were paying attention to 3-month treasuries. Why? Because we're trying to figure out what humans are deciding to do with this risk. And they're like, oh my God, get me out of the stock market, put me in a 3-month treasury. Give me 3 months to figure this out. Okay? That you understand, right? Maybe you're not used to looking at bonds. Maybe the idea of a bond or a treasury is new. But think of it this way. The stock market's crashing. You're managing other people's money, and all you do is buy the stock market. You don't even sell the stock market. All you do is buy the stock market. You're picking good stocks. And you're managing $1 billion. And then all of a sudden, every single stock is falling like it's the end of the world. And you're like, holy shit! And you pull your money out. It's the worst you've ever seen. Magnitude by 10. You've never even had a nightmare this bad. So you withdraw all your money and you put it somewhere safe. Now, in Japan, like I just showed you earlier, global finance is financed and funded by Japanese yen. So imagine there are institutions around the world that owe Japan money. Why? They took out a loan. That's what leverage is. They took out a loan from the Bank of Japan. They borrowed it. So you borrow 1 trillion yen from the Bank of Japan, you owe 1 trillion yen to the Bank of Japan. And they will charge you interest. Now, luckily it's not much, but you literally have 1 trillion Japanese yen now. You owe it though. But you don't want 1 trillion yen. The cool thing about the loan is you put up a little bit of collateral, maybe 1% collateral, and now you have 1 trillion yen. But what do you do with the trillion yen? You spend it. And you convert it to Australian dollars. Demand for Australian dollar goes up. Value of the Australian dollar goes up. Supply of Japanese yen in the world market goes up by 1 trillion yen, just floating out there now. Supply goes up by 1 trillion yen, the value goes down. Now, what happens when you freak out and the stock market's crashing? And you're like, oh my God, we got COVID-20 now. You dump your assets in Australia. Now you got dollars because you sold off all your assets. So you converted your asset, your physical asset, to a cash asset. And you're like, but I don't want my Aussie dollar. So you trade the Aussie dollar for the Japanese yen. So the supply of Aussie dollar globally goes up because you just dumped it in the market. You're buying yen as fast as you possibly can. So what's happened now? Demand has skyrocketed for Japanese yen because everyone is rushing to pay back their loans. That's all this is. You see? It's just money crossing a border. And you're like, well, what about German consumer confidence, eh? Irrelevant. Don't get complicated on me. Dumb it down. Okay? Dumb it down. Hey, I like hanging with you guys. I think it's time to wrap it up. It's almost 2 hours. Please leave a comment. Please like. Please subscribe. Please visit Trader's Way. If you need resources like a book, like video training courses, like a performance coach, like free training videos, my chart templates, and more, all those links are in the description below. Okay? And stop trying to be so smart. You're too pretty for that. Dumb it down. My name is Wayne McDonald. I'm a currency trader and the prophet of profit.